Imagine a company not just lauded, but practically deified as America's most innovative enterprise. Its stock price was a rocket, soaring to dizzying heights, and its executives were the darlings of financial magazines, often gracing their covers, symbols of a new era of corporate genius. Yet beneath this glittering facade lurked a colossal, meticulously constructed lie. The Enron scandal wasn't merely a corporate collapse. It was a spectacular implosion of deception and fraud, a seismic event that sent shockwaves across Wall Street, reverberating through the global financial markets, and ultimately, forever changing the very rules of corporate governance and accountability. Have you ever wondered how such a monumental deception could be pulled off? How could so many brilliant minds conspire in such a grand illusion? And what precisely led to its catastrophic downfall? Then you absolutely need to hit that subscribe button right now, because you will not want to miss this, and many more, chillingly shocking, untold stories from the shadowy corners of the financial world. In the vibrant, optimistic landscape of the 1990s, Enron emerged as the undisputed darling of Wall Street. Initially established as a natural gas pipeline company, Enron brilliantly, or so it seemed, reinvented itself. Under the visionary, albeit ethically compromised, leadership of its charismatic chairman Kenneth Lay and the relentlessly ambitious CEO Jeffrey Skilling, Enron transformed into a colossal trading powerhouse. They traded in everything imaginable, from complex natural gas contracts and electricity to pulp, paper, and even the seemingly intangible future of broadband internet access. Enron wasn't just a company, it was a promise, a beacon of the future, perpetually innovating its way to seemingly infinite profits. The corporate culture at Enron was relentless, defined by aggressive innovation, cutthroat competition, and a pervasive belief in their own boundless potential. Analysts and investors alike were mesmerized. Enron's stock price ascended vertically, almost defying gravity, creating an impenetrable aura of invincibility and unparalleled genius around its leadership. The core of Enron's meteoric, seemingly unstoppable growth lay in a highly controversial and ultimately fraudulent accounting practice known as mark-to-market accounting. Traditional accounting dictates that a company records profits only when revenue is actually received from a completed transaction. Enron, however, played by different rules. They boldly recorded potential future profits from long-term contracts immediately upon signing the deal, even if the actual money wouldn't be seen for years or, as it turned out, might never materialize at all. This allowed Enron to report enormous, often fabricated earnings quarter after quarter, projecting an image of robust health and explosive growth, completely detached from the underlying reality of their cash flow. It was, in essence, a sophisticated form of make-believe accounting, applied on an unimaginable, multi-billion-dollar scale, effectively allowing them to create profits out of thin air. But merely inflating profits wasn't enough to sustain the illusion. Enron also faced the daunting challenge of its ever-growing mountain of debt. To hide this critical vulnerability from investors and regulators, Enron, under the cunning orchestration of its chief financial officer Andy Fasto, devised an ingeniously deceptive, albeit fraudulent scheme. They created a labyrinthine network of intricate partnerships, often referred to as special purpose entities, or SPEs. These SPEs were ostensibly independent companies, but in reality they were controlled by Enron itself, often managed by Fasto himself or his associates. The primary function of these entities was to serve as dumping grounds for Enron's toxic, unprofitable assets and, crucially, for its spiraling debts. By transferring these liabilities off Enron's main balance sheet and into these shadowy SPEs, Enron was able to meticulously mislead investors, analysts, and regulatory bodies about the company's true precarious financial health. The financial statements painted a rosy picture of profitability and minimal debt, while the truth was a tangled web of hidden obligations that threatened to unravel at any moment. Enron fostered a corporate culture that was as relentless as it was toxic. There was an unrelenting, suffocating pressure to meet increasingly ambitious and often unrealistic profit targets, quarter after quarter. The internal mantra was rank and yank, a brutal performance review system where employees were constantly evaluated, and those who didn't deliver the expected results, regardless of how those results were achieved, were swiftly and unceremoniously discarded. This brutal environment meant that ethics were consistently sidelined, if not outright abandoned, in favor of closing the deal and generating phantom profits at any cost. Questioning the opaque, Byzantine accounting practices was not only discouraged, but could be career suicide. Dissent was stifled, and the pervasive illusion of unparalleled success was maintained with ruthless determination, creating a dangerous echo chamber where reality was ignored in favor of a fabricated narrative of triumph. Slowly, almost imperceptibly at first, the carefully constructed edifice of Enron began to show irreparable cracks. Investigative journalists, notably Bethany McLean of Fortune magazine and a handful of intrepid skeptical financial analysts, along with a few courageous whistleblowers from within Enron's own ranks, started to publicly question the alarming complexity and the sheer lack of transparency surrounding Enron's increasingly opaque business dealings. Articles in the financial press and detailed analyst reports began to raise serious, unsettling doubts about the true sustainability of the company's seemingly endless profits and, more critically, the staggering level of its cleverly concealed off-balance sheet debt. These persistent questions, initially dismissed as misinformed criticism, began to chip away at Enron's carefully cultivated reputation. The truth, once a trickle, became a devastating flood. As more details of the accounting irregularities and hidden debts leaked into the public sphere, the confidence of investors evaporated. Enron's stock, once a gleaming symbol of corporate innovation and financial prowess, began a terrifying, irreversible plummet. Desperate, frantic attempts by Enron's leadership to restructure their finances and secure new investments failed spectacularly. The contagion of mistrust spread rapidly. Even the venerable accounting giant Arthur Andersen, one of the Big Five accounting firms, which had infamously turned a blind eye to and even actively facilitated Enron's egregious accounting fraud, was inextricably dragged into the abyss alongside its client. Accused of obstruction of justice for shredding thousands of Enron-related documents, Arthur Andersen, once a pillar of the financial world, effectively ceased to exist. Finally, in December 2001, Enron, once valued at over $60 billion, filed for what was, at the time, the largest corporate bankruptcy in U.S. history, marking the end of an era of corporate hubris and deception. The devastating fallout of the Enron scandal had a profound and far-reaching impact. Thousands of loyal Enron employees, many of whom had been encouraged to invest their retirement savings heavily in company stock, saw their jobs vanish overnight and their entire life savings evaporate into thin air. Investors across the globe witnessed billions of dollars in wealth simply disappear. The sheer scale of the fraud spurred a furious public outcry and legislative action. The case directly led to the passage of the Sarbanes-Oxley Act of 2002, landmark legislation that dramatically increased corporate responsibility, strengthened financial disclosures, and established new, rigorous accounting oversight mechanisms. The catastrophic downfall of Enron serves as a chilling, timeless reminder of the absolute imperative of transparency, unwavering ethical conduct, and constant vigilance within the financial world. It underscores how unchecked ambition and systemic deception can corrupt even the most celebrated institutions, leaving behind a trail of ruin and distrust. What did you think of this shocking and complex story of ambition, deception, and ultimate collapse? Your insights are invaluable. Please share your thoughts and reflections in the comments section below. If you found this deep dive into one of financial history's most notorious sagas as captivating as I did, please do us a huge favor. Give this video a big thumbs up. Your likes genuinely help our channel reach a wider, curious audience. And share it with a friend or family member who appreciates a compelling real-life drama, especially one with such profound and relevant lessons for today's world. And remember, the sprawling, intricate world of finance is an inexhaustible treasure trove of countless mysteries, untold sagas, and invaluable lessons all just waiting to be explored. So, make absolutely sure you're subscribed to our channel and, crucially, hit that notification bell so you don't miss our next deep dive into the bizarre, often shocking, and always illuminating corners of the market. Thanks for watching, and we'll see you in the next financial fable.